Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in here. Let's take a look and see what people are sharing. If you want to follow me, you can look at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics and share my opinions more freely with the people in the community and how I'm playing this bull market that's coming up in commodities. The coupon code that we still have active is Mayday, MAYDAY, one word. 50% discount on the first month on a monthly membership, first month only, and a much larger discount on the yearly membership. And you can always switch from a monthly to yearly membership if you wish. So Brian says, the stock market isn't risky. The stock market only becomes risky when your holding period isn't long enough. And that's what I do. What I try to do is I try to find sectors that are inflecting from losing money to making money, which commodities are. You look at individual companies that could potentially inflect really hard. And what that means is that they are not making a lot of money, and then they start making a lot of money very quickly. That's an inflection point that inflects very hard, is what I'll call it, from losing a little bit of money to making a lot of money. And you need your time frame to be long enough to hold over those quarters that they are inflecting into positive territory. So the stock market isn't risky if you take the viewpoint that you can hold long enough for these companies to make money and inflect. And that takes time. It doesn't do it in weeks. It can't do it in weeks. Their earnings are only released every quarter. So if you're looking at companies that are down, they're putting in bottoming patterns, their sectors are strengthening, and you have to have a holding period that's longer than the inflection point. And a lot of the times the inflection takes months, maybe even years, a year or two, to really get moving. And that's how you get the big 10 times your money plus, is you have to hold for the business to inflect and start making more earnings. And then those earnings are distributed amongst the shares, which is your earnings per share. And that's what drives the stock higher, higher, and higher. And generally, that comes from an increase in the commodity price, or it comes from the increase of the service that they offer. But ultimately, it does come from the commodity price itself, and it takes time. It usually takes time, and sometimes it inflects really hard, and you can get a very big movement in a very short period of time, but you got to be in it before that occurs. So there might be a lead up period where you're in it, and it takes 6 months for it to really start to take off. HFI Research says, honestly, I don't know what's more ridiculous at this point. The IEA has been steadily revising down oil demand growth for 24 and 25. But then total demand stays the same because it's revising higher 2023 oil demand. At some point, you just have to believe the IEA is full of crap. I agree. I don't know if they've got these markets dialed in or not in terms of the demand side for oil. I wouldn't believe them. Breaking, Fed Chair Powell says the Fed does not have high confidence in their forecasts. I believe that. Another one from the Kobayashi letter says, what's happening with the labor market? The difference between full-time and part-time job growth has been deeply negative for the last 6 months. Over the last 50 years, such a divergence has only occurred in recessions. In May 2024 alone, full-time vacancies contracted by 1.16 million year over year, while part-time jobs grew by 1.5 million. Additionally, 1 million Americans have become unemployed in the past 6 months, according to the BLS Household Survey. Meanwhile, the unemployment rate jumped 4%, jumped to 4% from 3.4% in April, the largest increase since the 2020 pandemic. Is the US job market slowing down? And then he shows this chart, full-time versus part-time, and the year-over-year change. You can see at this level, it's pretty much turned every time, and we're at that level where it turns. So maybe the worst is behind us? Question mark. And I don't, just because you have part-time jobs and it's full-time versus part-time, I don't know how much validity this measuring stick has, this leading indicator, what he's using, but it's already low, so maybe it's already bottomed. That's what's difficult with some of this data that some of these guys do present. So scrolling down, we've got another one from the Kobayashi letter. Breaking, Treasury Secretary Janet Yellen says that U.S. debt load is in a reasonable place if it remains at current levels relative to GDP. Meanwhile, U.S. debt is currently rising by $1 trillion every 100 days. Who's going to tell her? The debt isn't staying in the same place. It's going up by $1 trillion every 100 days. Jan or Jan, it says, during the 1970s, when the 10-year Treasury rate went up from 6.3% to 11%, gold rose from $40 an ounce to $380 an ounce. And so that went up during a rising interest rate environment. I do think something similar like that could occur. And what could occur is that other countries don't want to buy the United States debt, and they look for an alternative for that money. And I think that money is going to go into commodities and precious metals, and gold being one of those things. HFI research says on a 4-week average basis, U.S. implied oil demand is holding up well. So oil demand is holding up well. It is at relatively high levels for the 4-week average U.S. implied oil demand. There we are with the gasoline, distillate, jet fuel, and other oil. So demand is looking pretty good. It doesn't look necessarily like this big recession that people are talking about. It's holding on at this current time. OPEC sees oil demand growing by 25 million barrels per day in the developing world through 2045, with China and India alone contributing 10 million barrels per day in demand. OPEC Secretary General Haytham Al-Ghayas called for continued investment in fossil fuels to prevent a shortfall. So OPEC sees way higher oil demand out in the future. I would agree with them. That's my viewpoint. I don't have any data suggesting anything different or contradicting what I'm saying. The IEA obviously comes out with data that contradicts that and says that the peak is in 2030 for oil demand. I just don't see how that's possible. I don't think we've got the minerals to support a mass adoption of electric vehicles. We're gonna have to have some serious re-engineering of everything if we can try to make electric vehicles work with the mineral intensity that they've got. Wall Street begging for rate cuts when the average house costs $420,000. It's not necessary. Well, yeah, the average house cost, it would just drive house prices higher if they do get the rate cuts. But it's supply and demand driven. The interest rates do not have as large of an effect than what most people think if you have acute shortages of things that people need. So the price continues to go up even if the rates are high, at least at this time. 84 Alpha says, all revised to reflect stronger demand, TMF. Do not lose focus because you expect something to happen positive to oil energy markets daily. These are the shifts that keep the thesis strong and intact. Those who have added unread the down days will continue to be rewarded. Thank you. And that's the IEA oil market, something which went unnoticed, demand level upward revisions. And those upward revisions for 22, 23, and 24, they're revising that demand upward. Unusual whales breaking, not even higher income earners, defined as those in the top 30%, can now comfortably afford to buy a home in the larger U.S. metro areas, regardless of their age, per CBS. In 2001, the top 30% of income earners could afford homes in these cities as early as age 24. So it does look like the affordability continues to slip away from even some of the higher earners, which are the top 30%. Maybe that is an indication of how messed up the market really is, of how much inflation and money printing is really going on, which is crazy. June global liquidity indexes report out today. A teaser chart still moving up. For world central banks, we are moving up in that global liquidity. We saw this in 2018-19, all the way up to 2020, and then it kind of turned over in 21-22. And now we're in another, quote, upcycle for the global liquidity index. So Brandon says, if you spend all your time focusing on copper demand, you miss the bigger and more important picture. Codelco, which is the world's largest copper producer, it just posted its lowest production month in 18 years. All the easy grade is gone. The cost curves are going to go up. So Codelco has the lowest month of output in nearly 18 years, and that's the world's number one copper supplier hit by setbacks at mines and projects. Decline, decline, decline. Fed expects only one rate cut in 2024, plus they warned of elevated rates in 2025. The rug pull is what he says. Says this market is even stronger than in 2021, despite a 500% increase in interest rates and a balance sheet sell-off. There's definitely something fishy going on. It's likely there's another balance sheet that we can't see. And I think he's talking about the stock market, because it keeps going up, even though interest rates are up massively, which also gets me kind of like, what's going on here? How do we have so much strength in the S&P 500 and these stocks with interest rates going up as much as they have? Generally, what you see is a money rotation when rates go up and they're held high like this. You'll see money rotate into precious metals and oil specifically. And you'll see the S&P go sideways. But we're continuing to see buying pressure in the markets, even though rates remain very high, which is very fishy. I agree. Great Marti continues to call tops in, and that's why they're calling for tops. A lot of these guys, they're calling for tops because interest rates are high. And that's what causes tops in the markets, is when you get an increasing interest rate environment, it stays real high, money rotates out of the S&P 500 and may go into bonds even, or commodities. And we just haven't seen that rotation of money yet, in size at least. Citi sees oil prices crashing to $60 a barrel in 2025. That's what Citigroup sees. That would mean that they are in the recession camp, definitely. If we do get a $60 a barrel in 2025, I will be a massive buyer. I still think that we're in the middle of an expansion phase of real estate. That would be your pullback that gets everyone flushed out. It'd be your selling pressure flush out. And then I think we're going to see a big move in oil late 2020s. If that does occur. I'm not betting on it right now that we're going to get this big pullback, but I could see it is possible that something like that could occur. I'm remaining open to it, but we got to see the 2-year yield drop. And that's what we haven't seen drop yet, is that 2-year yield falling off a cliff, signaling that people are running into bonds, the big money, and that a crash or slowdown could potentially be coming. We've got the heaviest concentration in history. The market cap of the 5 largest companies as share of the S&P 500 total is even higher than the bubble of 2000. When your breadth in the market breadth shrinks like this, that's generally pointing towards a bubble. So you get all the smaller cap companies kind of falling off, and then it concentrates on the largest companies in the S&P 500, and that's exactly what we're seeing. And that's generally bubble territory, just like 2000. So if we're close to 2000, and you guys have heard me say this, maybe the yield curve inverts and maybe we uninvert. We get a slowdown in the market because we are seeing concentration go up, et cetera, et cetera. That's when we'll see yields drop and the dollar drop. And it'll look very similar. Like we might get a pullback in everything for 6 months to a year. And then we see a 2002 type scenario where house prices continue higher. We see a winner's curse phase in the real estate market for real estate, which home prices go up substantially. And then we see the dollar drop and commodities rip, much like 2002 to 2008. And that would mean that we have maybe 5, 6, 7 more years left in this bull market, which puts us towards 2030 for a potential peak, if that were to play out like that. HFI says, that is one of the strangest EIA oil storage reports I've ever seen. Other oil demand category drops 1.5 million barrels per day. Wow. U.S. crude imports hit over 8.3 million barrels per day, with the adjustment hitting a massive minus 1.15 million barrels per day to account for the massive import overstatement. Kind of weird stuff going on in some of these reports that we're getting out of the EIA. Almost like they're doctored. Dow versus gold, and I just like this chart so much, says gold is clearly broken out of a huge cup and handle pattern and is on the verge of an all-time high quarterly and 6-month close. Yet, this place remains littered with commenters focused on the bearish wrinkles between impulses higher. The trade is on the longer time frames, guys. Don't focus on the short term. Ride the big long-term wave here. We've got the cup and handle. Like, we're going to go way higher here, in my opinion. Just like Dow gold equals 1, I agree with them. Play the longer time frame, the bigger pattern. Mason says, remember, people in emerging markets and developing economies consume 4 times less liquid fuels per person than those in advanced economies. So North America, this is advanced economies, and the OECD consume 4 times as much liquid fuels per person than emerging market and developing economies. And this is the consumption here. 12.6, 8.7. You can see the guys down here. They don't consume anything. When these guys start to consume, it's going to drive demand higher, 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 and higher. And that's what we're playing. We're playing the S curve over in Asia and India. It's coming. Things you can see close to a bottom. It says it's not a good idea to buy palladium during a recession. What a completely worthless metal. And he's just saying that's what you see close to a bottom. And palladium is getting down there, and I think that we will bottom soon. It's going to take some basing first. This is from Wolf. He says 90% of investors lose money because they lack patience, they follow the herd, they invest on emotion, they chase performance, they invest without a plan or strategy, they don't align risk tolerance, and they don't understand the asset. Actually, there's a lot of people that have all 7 of those traits. Being patient is huge. You have to not follow the herd, which is very difficult to do. You buy when no one's really looking at it. So you're not chasing performance or buying off of emotion. You're buying patterns is really what you're buying. We have strategies. The strategies is the 3 pillars. And then my strategy for portfolio allocation, I just put that up on the website. It was the question and answer session, last question and answer session, where I give a couple of different strategies, and it's really two strategies, and why I adopt one of those strategies, which deals with adopting more very large asymmetric bets and why it works out in terms of returns. The symmetry is so big, so it's all that. And this goes with rule number 2: follow the herd. When you don't follow the herd, it says when everyone's afraid is the most bullish sign I know, which is basically you don't follow the herd and you don't invest on emotion. You do exactly opposite of that. You run in and buy all the shares you can when everyone is emotionally unstable and scared. It says a reminder that all fiat currencies trend towards zero in terms of gold over the years. So 1971, and everything's trending to zero in terms of currencies, fiat currencies. The Shanghai silver vault fell to the lowest level since January of 2016 to 697 tons or 22.4 million ounces. You can see the decline there. Another one with the S&P 500. He says, "Oh, we are so close. Technical poetry for one's private perusal." And this is a rising wedge coming up in a potential break, and that is one that I identified. We can also see that momentum is going down. This could impact our commodities and draw us down to the downside for a little bit. The yield curve would uninvert if this does occur, would be my guess, and that's something we're watching. Is that 2-year yield to see if it drops. ISM, so it says a soft recession occurs when the manufacturing side of the U.S. economy contracts while services remain robust, leading to a period of a slower economic activity. And right now, we've got the black, which is the ISM Purchasing Managers Index, going into negative territory under 50. And then we've got the red, which is the ISM Non-Manufacturing Survey Index above 50, which is growing. And that's where he says that the U.S. economy contracts while services remain robust is that soft recession. Are we in that already? Some people are kind of speculating like, yeah, we are. And maybe we're in it and we're going to come out of it at some point here. So maybe we're already going through it. The Great Marty, this is Apple. He says, oh my. And this is the Wyckoff distribution schematics. He's overlaid the distribution over that, and it matches it almost perfectly, where people are selling their shares into the market. It creates this distribution pattern, the Wyckoff distribution schematic, and maybe we get a move lower for that Wyckoff distribution schematic there. So I actually think that looks pretty close. It really does. And maybe we get a slowdown in technology and whatnot. We uninvert the yield curve, and that is still all possible. I'm not bringing it off the table. We already talked about that one. In the 1990s, Japan's massive real estate bubble popped, and it still hasn't recovered. It's known as one of the largest real estate bubbles ever. Canada is the orange line. It's literally twice as big. So here's Canada, the orange line there. It looks pink to me, but orange, pink, and then Japan. Now, what drove that is the demographics. Japan's demographics contracted, and so did the real estate market. If Canada has a contracting demographic, which I don't think it does, then it may not look the same as Japan because you have to have the size of home buyers shrink. China definitely has that right now, and that's where you get these big bubbles. It's a mismatch between the demographic and the real estate market in that area. Colin says the housing crash folk talk about how home prices need to fall because mortgage rates are much higher today. They say home values are based on 3% rates or something to that effect. And now that we have 7% rates, prices need to come down to reflect the higher cost of financing. But when you look at the data like the map below, you realize it's all just supply-demand driven. Check out the cities where available supply surged: Austin, New Orleans, and to a smaller degree, Phoenix and Tampa. Then look at where the home prices are under pressure. Yes, those same cities. The opposite is also true. Prices are flying higher in LA and Miami, along with other smaller metro where supply is tight. Ultimately, it boils down to how much available supply there is, not the mortgage rate that's available to Americans from coast to coast. Not to mention cash buyers who could care less what the 30-year fixed is averaging today. You can get the same 7% 30-year fixed in Austin, Texas, where home prices are off 18.7% from their 2022 peak, or in Knoxville, Tennessee, where they're up 10.2% from that period. What does that tell you? It's based off supply and demand. Totally agree. And how tight that market or how loose that market is. I completely 100% agree with that. And interest rates, I hate to say it, they go up with home prices and they go down with home prices. Because when you hit the peak and you overbuild, you have too much supply, home prices will go down with interest rates at some point if you overbuild. So I just wanted to touch on that because he's 100% right. And there's the chart that he was talking about. This is your active housing inventory for sale compared to pre-pandemic levels. Anything that's dark brown is below, very below the 2019 levels. And then the ones that are in the blue here, those have more inventory levels. The killer chart for commodities here, this is the U.S. Commodity Price Index 10-year rolling CAGR. Real low, and we're going to head higher. And they've got an estimate of 2045 of the big long-term commodity bull market super cycle. We've had a super cycle from 1800s, like 1820 something, all the way to mid 1860s or so. We had another super cycle from 1875 all the way to the 1910s. Another super cycle from the 30s to the 50s. And then we pulled back in the 60s and put it all the way up into the 1970s. Now we're all the way back down, very low in the 2015, 16, 2020 range. And we're working our way back up. It says, Willis, we wait for the gold to SPX ratio to comply. Another ratio chart is signaling a probable long-term precious metals bull market. And this is the US dollar index versus gold. And every time we fall downward, which we've broken below that level already, we could be seeing a big bull market in gold. It says the orange arrows coincide with large bull runs for gold. And he says a huge gold bull market ? As we've broken down for the US dollar index versus gold. And that has happened many times in history of these big bull markets in gold. And it's occurring again. We've got a wheat chart here from Grady. And this looks like, basically, I'm just going to go over the chart here. It's a 45-year parabolic base is what he says. And it's a double bottom that we're breaking here to the upside and ready to continue higher for wheat. It says this chart covers the fiat paper money era since Nixon closed the gold window back in 1971, an era of currency printing. And that's really what's driving it. It's currency printing. The bad stuff. It's the denominator getting blown out, which is the dollar. And that's where we're going to end it, guys. So that's all I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't already. And we'll catch you guys Sunday at 5 p.m. Mountain Time for the question and answer session. So that's all I've got. We'll catch you next time. This is Finding Value.